across and get some opinion before that. Rajat Rajgarhia of Motilal Oswal joins in first. Morning, Rajat. What's your sense now? Is it a time to accumulate stocks, or do you think you will get better entry points over the next few weeks?
Good morning. I think we will get better entry points over the next few weeks. Yesterday's RBI's policy document was a pretty good reflection of what the underlying environment is, and they upgrading their inflation estimate to 8% by March end. And by the way, this is the third consecutive month in the market that we are seeing inflation estimates being raised. So it looks like inflation has a risk to upside, growth has some risk to the downside, and crude doesn't seem to be providing any respite. In this kind of an environment, there's a reasonable probability of one getting prices lower to have better entry points.
Rajat, morning. How much lower you think? I mean, would you be surprised by something more than a 5% correction in the market?
Well, 5% is something which definitely is possible, but it all depends upon how the situation is evolving. Because first, on the domestic front, we are definitely going to see inflation providing us more negative surprise, because just the first week of March inflation for food and fuel is higher than the Feb end inflation. That's one. Second, on the global front also, both on the right you have Middle East, and on the left of India you have Japan. Things just there's no good news flows which is coming for the markets to be better. And if you keep on getting some kind of a shock either on the domestic front or on the global front, markets can drift down even further from here.
How would you approach the interest rate sensitive sectors, Rajat, now after what you heard from the Reserve Bank yesterday?
I think you will definitely see interest rate sensitive sectors seeing more correction in the market, because they should drive down the market. So whether it is financials, whether it is autos, real estate, even companies which have high borrowings in the mid cap space, there's a reasonable probability of all of them going down, and you will get better entry points into all of those stocks.
A lot of sensitivity analysis has already been done, Rajat, on every dollar rise in the crude and its impact for the market. At this point, do you think people have factored in 100 plus on crude when they're working with earnings expectations for FY12?
I don't think that the 100 plus of crude has been factored into the estimates, because first of all, as far as the earnings are concerned, they don't see much impact, because we know that the crude is very well protected in the domestic market because of the regulation in the prices. But it's to do with the P multiple of the market. Currently we are trading at roughly around 14.5 times, which is just the mean P over the last 5-year, 10-year period. And if you have a headwinded environment of $100 plus crude, then you see this spreading to a lot more other commodities also, which in turn drive down the margins and drive down the valuations for the markets.
Rajat, have you had reason to revise your price target on Reliance?
Well, our price target on Reliance has seen some upgrade, first driven by the continued strength into the refining margins, and second, of course, the cash coming into the books next year will also have some implication. But given the fact that it's a combination of three big businesses, the price target doesn't changes by more than 5-7%. So for Reliance, the key critical point still remains that if the gas volumes, which currently have been seeing some stability at 52-53, how do they move from here for us to change our price targets for the stock from a 1-year point of view?